All right, so hey guys, hey everyone. Thanks for joining us today. If we haven't met yet, I am Steve Frye. I am a realtor and the exclusive Savvy short-term rental rep here in Nashville and Middle Tennessee. A little about me. Before I got into real estate 6 years ago, I spent about 20 years in corporate finance. So I bring a pretty analytical corporate investor-focused approach kind of to what I do. So that approach has helped me to sell over 220 homes and 120 million in real estate in those 6 years so far. So these days, I work with investors from all over the country, helping them find high-performing short-term rentals and other investment properties right here in our market. So it doesn't matter if it's your first property or if you're adding to a portfolio. I love helping investors find the right opportunities, navigating the local zoning and STR regulations. We do have regulations here in Nashville, like most big cities, but our city has stuck to their guns on those regulations over the years. And as long as you know how to navigate it, there's plenty of opportunity right here in Nashville. And setting yourself up for a successful and long-term cash flowing asset. So I'm also pumped to introduce someone today I partner with regularly. His name is Mark Neely with Neely Lending Group. He works with investors nationwide, not just on financing, but he specializes in the tax strategy side of using cost segmentation. Um, right now, of course, there's a ton of buzz around bonus depreciation and cost segregation, and for good reason. There's even talk about 100% bonus depreciation coming back. I know in the news right now, it's exciting. I think right now we're at 40, so going back to 100 would be amazing for the next couple of years. That'd be a massive opportunity for anyone, of course, investing in STRs, where you have to show as part of that that you have some you're part of the management of the property. So we're talking about being able to knock down a huge chunk of your personal taxable income just by making smart real estate moves. Mark's going to break all that down for us and explain how you can use these strategies to make serious money, also building your portfolio. So stick around, guys. This is going to be really valuable, whether you're new to STRs or just looking for better ways to scale. So, Mark, I'll let you take it away, buddy.
Thanks, Steve. And
Yeah,
I appreciate it, Lou. Thank you so much for having me here. I'm in Nashville in the Franklin area. Um, I've got a chat box open. I don't know. I'd love to see where everybody's coming from. So, if possible, if you just drop in the chat where you're dialing in from, that would be great. I don't know, Lou, if you want to say that's possible for me to see that.
gotcha.
Anyone? Is anyone there? I can't see who exactly is on, but
Yeah, I don't see anything else
okay,
yet. Come
guys.
in.
So no problem. So, guys, what I'm going to talk to you about today um, is, how you can really position yourself to be, a hero in this current market. And right now, a lot of people are looking at STR opportunities. It's very difficult to make the numbers work. You just would be surprised at the number of people that either don't know about cost segregation. So you kind of have a couple different categories. People that, and I was in that category. So I became a client in the cost segregation world first by buying a short-term rental. Um, and I'll tell you a little bit about myself. But so I'm born and raised in Nashville, live in Franklin with my wife and three children. We own a home. It's a short-term rental in 30A. We've got some commercial property and investments, and we've got a midterm rental here in Nashville. I'm a short-term rental specialist, an equity advisor, a tax strategist. So what I do is I help people figure out the way to get the funds to purchase the home and then optimize their tax savings to make the numbers work so it cash flows. When you start introducing cost segregation and bonus depreciation into the equation, now all of a sudden something that maybe doesn't pencil, all of a sudden it does. So category one, going back to that, you have people that really don't know anything about cost segregation, bonus depreciation. Yeah, I've heard of that. Then you've got people that, yeah, I've heard of that a little bit, but I don't know much about it. And then people that they've contacted their CPA, their tax preparer. And so I use quotation marks because a lot of CPAs are simply tax preparers, and they really do a just a really high level overview. And they're I can't tell you the hundreds of people that I've talked to over the last few years who say, my CPA told me that we just don't qualify for this. We don't meet the material participation rule. We would only be able to deduct the passive income. Guys, what we want to talk to you about and explain the power with this is how people move their income deductions from the passive side to be able to deduct their actual active income. So doctors, attorneys, business owners, these are the folks that are out there buying short-term rentals, sometimes solely for the purpose of really getting the tax deduction. They have to buy property. You have to understand, guys, there is a massive opportunity. There's people out there that need to buy property because when they get with a tax specialist like us, like the team that I refer people to, all of a sudden now the strategy is very, very clear, and they understand that, okay, I made X amount of dollars this year. I need huge tax deductions. I'm tired of writing huge checks to the IRS, six-figure checks sometimes. What can I do to mitigate my tax bill? Well, the absolute number one way that people do it, whether it's me, you, our clients, or people in Washington, whether it's the Trumps, the Clintons of the world, all of those people and everyone is as absolutely is using this strategy. Disney is using it. Coca-Cola, they absolutely are using cost segregation. People that own Kimpton hotels, everyone is using it. So we're going to go over today kind of what this looks like, and I'm going to explain it in detail. All right. So why you should care, it lowers your buyer's after-tax costs. So it's going to be higher return on investment for your clients. It creates a purchase urgency for 40% before the 40% bonus fades. And it positions you as a tax-savvy short-term rental specialist. The bonus depreciation, which Steve talked about, is vanishing. Okay, so we want to try to capture this before. All right, you can kind of see now. The hope is that the bonus depreciation to go back to 100% with the new administration, which Trump is the one who actually set this into motion to begin with. For the bonus depreciation back a few years back when his first term. Now we feel like it's on the table. It is on the table. It's already before committee to be signed off on. Whether it gets done before the end of this year or not, it really doesn't matter. Always remember this, because sometimes you're going to talk to people and say, "Well, I've heard that the bonus depreciation is coming back. Should I just wait till that occurs before I get started?" And the answer is no, because our team is going to go back and they're going to capture it retroactively. So you don't have to worry about missing out on an opportunity that comes along, because as you all know, the market's easing a little bit, right? You're seeing longer on the market. People are coming down on prices. We spend a lot of time on the 30A area. So that whole panhandle area is a really great area to be able to purchase short-term rental. I mean, they're not making any more beaches, right? So this is what it would look like, for example, on a 40% bonus depreciation. So right now, say a $750,000 purchase price. Easy math. Typically right now with the bonus depreciation as it is, is just an easy way to look at it. It's about 15%. So is about what you're going to get. So 750,000 times 15% is about $112,000 tax bracket, or $112,000 tax deduction. In a 37% tax bracket, that's about $41,000 in taxes saved. So that's realized gain, that $41,000. Hello from Salt Lake there, Matt. Good to see you. STR specific edge. So you combine with material participation. What this basically means, and our team really walks through and consults the client on how they need to participate in the management of the property. So you don't have to have you don't have to manage it 100% yourself. You don't have, but you can manage it. You can have a management team, but you do have to participate in some way. So what's going on is you have a property that you buy. The IRS looks at a short-term rental the same as a business. So they look at it as a hotel. So now all of a sudden, instead of having a deduction of straight line depreciation of say 27 years on a residential property, now it's 39 years. That's a huge difference. But the bigger thing is when you're categorizing these different deductions in the 5, 7, and 15-year buckets, and you're bringing all that depreciation into year one. So it boosts the cash on cash returns. It sweetens the DSCR ratios. I'll get into that. DSCR is just a loan that we do a lot of, which is asset-based lending. So what the idea is, somebody has income of say $300,000 and they're self-employed, all of a sudden now they've got income that's knocked down from 300, knocked down $112,000, and their tax basis goes way down. So you can imagine as this goes up, or the price point goes up, how much the deduction goes up and how the bigger savings are. So some people are actually buying, we have clients that are buying 2 properties every single year specifically for offsetting their taxes. And it's just rinse and repeat. So there's guidelines around it. Your realtor playbook, flag the ideal properties, new builds, luxury finishes, introduce buyers to a cost seg specialist before closing like us, market with projected 1-year write-offs, and leverage case studies in your presentation and your social posts. We can help with that. You're going to be able to, if you follow me, I'll put my I'm going to put my Instagram handle into the chat here. I put out a lot, and this is also my YouTube channel. So I have a lot of interviews. I interview a lot of the top agents around here and also in the 38 area that specialize. I've had Jonathan Spears on my podcast. We filmed that. Jonathan Spears, it's already closed about $250 million thus far this year. He's a #1 agent down there on the Panhandle. He's with Compass, about a 31-year-old guy. And he has a team that just really, really does a high rate of business. All right. So things to look at for 2025, run illustrations on deals in the pipeline, lock studies in by 12/20. So really the idea is the bonus depreciation of 40% is for this year. It actually goes down to 20% next year. And really tracking it's important because it goes by the date of service. So it's when you place the property into service. So they could literally buy it this year, put it into service, and capture the 40%. So lastly, you just want to team up with a team like me in our tax team. So what I do is help them figure out the best way to fund the property, and then we're integrating the whole tax strategy into it so that they understand what they're getting into, what their implications are, what their savings are. Now, before I go any further, is there anyone that has any questions? Feel free to drop something in the chat if you want me to address anything. We have 30 attendees. Great. Lastly, if you want to, let's see, if you want to schedule book an appointment with me, a short call, here's a QR code. You can scan that. Let's see, somebody here is Somya. Wanted to ask about EBL, excess business loss, offsetting W-2 with cost seg depreciation, the limit being 626, and how much does it work if we have both income from W-2 and business income from short-term rentals? So this would be a great question so our team is really a family office style boutique firm that's made up of 1/2 CPAs and 1/2 litigators, 1/2 tax attorneys. The CPAs are former Big Four. They work for Ernst & Young, tops in the business. We've done about 300 cost segs the team has in the 38 area. We've done probably 150 in the Nashville area. and we go all over the country. So we've done in Oregon, California, obviously South Florida, and up east, New York State, everywhere. So that is a great question, and I will be glad to forward to the team, Somya. Any other questions? I mean, this is just a great strategy, guys, that you need to know. You know, right now it's tough sledding out there. You've got, prices are still staying relatively high. A lot of people haven't really, a lot of sellers haven't really come to the conclusion, to the reality, the realization that they can't get their, for their property, the price that their neighbor got, last year or a year before. So it's very difficult to, sometimes just to make the numbers work. It's difficult to get people to understand. I put out a lot of content about this. I host webinars. I teach classes. Steve is very active in the short-term rental market. We have a lot of athletes. Obviously, we have the Predators, the Titans, and a lot of these people, they get contracts. The first thing that their advisement team, their financial team, their wealth advisors are going to do is figure out ways to mitigate the taxes of this big check they're going to get. Well, owning short-term rentals is, one of the number one ways to do that. It's one of the simplest ways. It's one of the best ways that, the IRS gives us an advantage to be able to take these huge deductions.
Yeah.
Hey, Lou, that's all I've got. Yeah, go ahead.
Quick question. So I know one of the questions I get fairly often is people that buy short-term rentals, sometimes they self-manage, sometimes they got property managers involved. And it's with if someone has a property manager involved in a property, are they, I know there's a minimum number of hours they kind of have to participate in the management of that. I understand sometimes they can co-host along with on that property. But do you guys have any? What do you usually tell folks when they ask that question about how much they have to participate?
Yeah. So on this slide right here, 100 hours. So basically, what happens is, you need a log. You need to keep a log, and it's really just for the year that you're taking the deduction. So a lot of times you use the first deduction. So we bought a $1.25 million house. We got a $350,000 tax deduction. The bonus depreciation was at 80% at that time. Well, what we did is my wife kept a log of the hours that we were searching for our home, which counted towards the 100 hours. What we're talking about, guys, is what's called material participation. Our team gets really into the nuts and bolts of advisory, consultation to consult every single cost seg client that comes through the door, which are hundreds per year, that to explain what they need to do to keep a log. So it's three rules. The property needs to be an average nightly stay of less than seven nights or less. Okay. So it's not long-term rental, mid-term rental. So we can't do really a cost seg. It doesn't make a lot of sense for cost seg on long-term rentals. Sometimes it does. It makes a little bit, but really where the biggest value is when you turn it into a short-term rental. So the answer to Steve's question is that you keep a log. 100 hours a year is what you need to log. So that's really about 2 hours per week. Now, do you have a management company? The management company does things like market the property, but we're participating in things like setting up, people that are going to work on the house. We went down and spent time working on the house. We're logging all these things. We're going out shopping, buying things for the house. We're on the phone talking about replacing the pool heater. These types of things all need to be put into the log. Marilla, is there anything else that you can think of that would be? We also market the property. So it's very, very easy and you got to understand, these are the types of things that the IRS, are fairly lax on, meaning this is not a high priority to them to be policing, litigating short-term rentals, but you do need to keep a log in case of an audit. Now, with our team, when we do cost segs, it comes with full audit protection. So again, we have CPAs that are top notch in the country. We do cost segregations for Kempton hotels. $15 million hotel. Hotels get an even bigger cost, and multifamily get bigger spread. So it might be a 40%, cost segregation or tax deduction on a hotel. So you might have a $100 million hotel. They might get a $40 million tax deduction. So you want to know how people that are billionaires are paying zero tax or little tax in terms of their income tax portion. They're paying a lot of taxes elsewhere, but this is the way they're doing it, is because they're buying property, and the IRS really, really rewards the American consumer, the American, property real estate investor in a tax sense. So you really can't have any one person that's working more on the property than you. So the only time, and the team goes over this, the only time this ever comes into play is if you're dealing with a management company that has one cleaner. So one person who's cleaning the house, and that one person, Sarah, we'll just call her, is the only cleaner that you have. You will want to make sure that they're rotating Sarah. Okay, that's really kind of just a nuance to it that you would want to make sure, because if Sarah's there every single week doing turnovers, Sarah could be working, 150 hours a year on the property, and you wouldn't want that in the event of an audit. So worst case that happens is they say you can't take the deduction, but we have never lost an audit when it comes to cost segregation. There's lots of other products that the team consults on that are non-real estate related, but basically we work on big ticket items, which are cost segregation, employee retention tax credits, and then research and development tax credits. But in real estate world, it's all about the cost segregation.
I was going to say, Mark, you made a great point a while ago about looking for the property, doing all the front end work, lining up contractors, because bonus depreciation and cost seg is more about that front end write-off. So most of those efforts, this isn't as much about ongoing management, but when you're initially looking for the property, getting the property ready for market, getting it furnished, getting it out there that first year, you are doing a lot of hours of work. It's not like you're in year 5 and you're just you're trying to co-host and manage the property out.
Right, exactly. We've got a question here from Brandon. Assuming 100% returns this year or next, whichever it is, what's the simple calculation? Back of the napkin, 25%, I would feel comfortable with. Sometimes it'll drift up to 30%. Here's the deal. When you get into this world, there are going to be people, you're going to start to learn that there's, certain CPAs may say, hey, I've got a good cost seg person, and but it's kind of, they're a discount cost seg. I mean, I've been in real estate deals, commercial deals, as a limited partner or general partner, and, someone else is running the show, calling the shots, and all of a sudden you realize that the person that they have doing the cost seg is not that great. Now, how do I know? Because, I get our team, Jason and Brian involved, and these guys, they specialize. They do massive deep dives on what is allowed. And so there's just a lot of times things are left on the table. There's money left on the table, is what I mean. So there's deductions that aren't being taken that should have been taken. So, you've got somebody that's doing some discount cost seg, but, the deductions that they come up with are 100,000. Whereas if, our team, it may be double what their fee was, but we may be getting $100,000 more in deductions, and it pays for itself. The return on investment on the difference in the cost for the cost seg is, a 3x ROI. And by the way, we would never do a cost segregation for someone unless we look to get a 3x return on investment. So a 3x ROI. So if someone's saving, $47,000, let's just say $40,000, or $30,000, we'll say they're saving $30,000, the cost for the cost seg shouldn't be more than $10,000, and vice. But typically we're going to start with homes that are probably in the 750 and above range. That's where we see the biggest impact for people. We do sometimes go down to 500, but our clients are really savvy investors that are anywhere from single family owners, beach properties, to hoteliers. Contact information again, yes, Kate. 30A isn't most of the value in the land. It depends. If it's on the beach, you're going to have ours is not. Ours is, here's my contact info. Yes, condos, you can do short-term, you can do STRs. There's no land involved. So anytime you're doing what Kate's question has to do is when cost seg, when you're doing these deductions, you're taking out the value of the land. You have to remove that from the equation. You're taking deductions on things like the cobblestone around the pool heater, the shiplap, the countertops, the lighting, all of these things, all the way down almost to the studs of the wall. So anything but the structure itself. So all of those things, that's where having a really top-notch team, because like I said, Kate, if you were on earlier, what I was describing is our property was 1.25 million. Now this was in 2021 when he put it in service, but we got a $350,000 tax deduction, and we're 500 feet, maybe 1,000 feet from the ocean. So we're on the other side of 30A, but we're like one street. We're behind Cafe 30A. So right behind the Tom Thumb. So we're on that street right there. So you have to have a top team that can really justify making the value of the land lower, but it's got to be justified, right? But our team knows how to do that. So they're working within the guidelines to get the value of the land as low as possible and the value of the items that are being deducted as high as possible. But you're absolutely right. If you're on the beach, a lot of it's going to be in the land. It is going to be that. But we've done cost segs for $15-18 million homes, on 30A.
Hey, Mark, quick question. Do you see valuations or the percentages any different for people that buy fully furnished properties versus, they just buy a property, they come in and completely renovate it from scratch?
It's a great question. I'm not sure. So I'm not a CPA. So that's one. As far as the furnishings, I'm not sure if those are going to be counted or not. I don't think so. It has to be, I think, affixed to the property. Sofas, things like that. Yes, are not going to be covered. Soumya, I'll get an answer to your question. And if you'll drop your email address or email me, I'll get back to you on your question. I'm going to do a screen shot. But you're asking about the limit of 626 in 2025. How does it work if we have both W-2 business and business income? It's really all of your income. So, all right, Copper Ground Holdings, got it. Any other questions? Is this helpful for you guys? If anybody's heard of cost segregation, let's just say, just drop a 1. Or if you haven't heard of it, drop a 2. All right, C. Ray, Frye. Is this helpful for you guys? You feel like it? Drop a yes. Worth the money spent. Curtis, I agree. Curtis, where are you from? This also, obviously, just to reiterate, works for commercial properties too. So you have an investor. Frankly, for us, for me, my primary source of income is not from business development for the cost seg team, but it's from closing loans for my clients. So it's for doing fundings, whether we're pulling equity out, as an equity advisor, we look at, hey, can we get money from, home equity line of credit to put 20% down? You want to buy this $800,000 place down in Prominence on 30A or in Austin or downtown Austin or Nashville or wherever. Where can we get the money? Well, we've got about 100,000. Okay, can we get some money from a HELOC? And so we would look at that, right? Branson is a great place to buy. here we have East Tennessee, the Smoky Mountains, which Steve's very familiar with. Then you got some areas over in North Carolina, which are great. But um, very much worth the money to have cost savings. And it works on commercial property. So a lot of times, you have clients, they have short-term rentals, but you start getting into, their once we consult with the tax team consults with them, well, they own a business. They're about to do an exit on a business in a few years. They own a commercial property. And this is a way for you guys, because Curtis made the introduction or Kate makes the introduction. And hey, by the way, gosh, thanks so much, Kate. Your tax team just saved me like $200,000 in taxes. I've got some other things going on. And so we really do a comprehensive approach. The team does for what they're doing when we consult with these clients and have these interviews and have these consultations. It's not just about figuring out, hey, what's this one thing that we can help you with, check off the box and move on. We get into what's their business, what are they doing. We turns out one of my neighbors down in Florida, financial planner guy, and doing about an 8-figure exit, selling his portion of his financial planning business. He's going to have a massive tax bill. So got him on a call. We've got a game plan together for him to help mitigate taxes. Current rates on HELOCs, typically fees on HELOCs. So very, very small to none on the fees. Rates are usually around prime to prime plus something. So prime plus a half, prime plus one. So somewhere in the sevens usually is about where rates are.
Yeah, and we have Mark here today, of course, talking about the tax strategies because he's partnered with a really, really great group, very reasonable, very knowledgeable. But Mark on his own, as I mentioned it earlier, he owns and runs Neely Mortgage Group, and he's not only a fantastic lender for Tennessee, but lots of states throughout the country. But he also, he could do all the stuff that banks can do. But he's also got a lot of the private lending options as well. Some of the non-QM things where it's just kind of where you get really creative and sexy in the lending world as far as being able to really make investor deals happen. For some people,
yeah.
Whether they show income, whether they don't, whether they have assets or bank statements. But he's fantastic at all that.
Yes. And Kate, yes, my team can do loans in Ohio, so we can take care of clients there. But yeah, I just got a call just before I hopped on. Someone did a bank statement loan. So bank statement, profit and loss loans. We do a lot of asset-based lending. So a lot of times, I do a lot of social media posts. I do a lot of education. I'm active on social media. Probably not as active as I have been the last few years, but I was one of the first people to sort of grow my account on Instagram pretty quickly a few years ago. And now I'm sort of just paring down my audience. But really an easy post that you can come up with, and you can get AI to help you with this, but you can prompt it by saying, look, I want to do a post I know I have a lot of friends who are out there who probably have thought about buying a rental property, but they don't understand. And you can speak this into the Chat GPT prompt, all just audibly. And I'd like to explain to them, what they can do to mitigate taxes and at the same time own a property in the mountains or at the beach. Can you help me come up with a one-page post or a carousel, whatever you want to do, or a video script to do this post? And I want to create 5 of these posts. It's an easy way just to start educating your audience and start being the person that they think of when tax time is here. I mean, what happened just last month? People got a big tax bill. They realize they've got to pay it. They file an extension. It's a great time to start hitting people with this, to realize that, look, now is a great time. Do you understand that the biggest tax deduction available to the American consumer is real estate? And so I can show you how to offset. You got a $100,000 tax bill or $50,000 tax bill. What if I could show you how to own a rental property in a vacation spot that you like, and also get rid of that tax bill. Would that be something of interest to you? Reach out, send me a DM, and let's hop on a chat. And I'm always happy to. I'll give you an example of a realtor that just last week reached out. This is very, very common, but had a client moving or lives in Maine. She's actually a realtor up in the state of Maine. Wants to buy a short-term rental here in the Nashville market. The numbers weren't penciling. And so she'd never heard of cost segregation. She'd never heard of bonus depreciation. She never heard of these types of deductions. Get on a call within 15, 20 minutes, kind of gone through all the options. Next thing we're issuing her a pre-approval letter, and she's out looking for somewhere in the $800,000 range. So she just didn't realize that, look, she buys a property, and now you've got like maybe $40,000 to $60,000 of money that's coming back to you. That's first year cash flow increase of $40,000 to $60,000. It absolutely swings the pendulum from it not making sense to, okay, I need to really figure out something to purchase here. Even if it's not cash flowing a lot, it's the tax deduction that I'm saving, that I'm getting, and the taxes that I'm saving. It's really making up and making a huge difference here in their financial world. These are great conversations to have with people. And here's another thing, guys. It's a new and fresh topic. It's a conversation that you start. Everyone pays taxes. Not every single person is necessarily looking to purchase a rental property. They may think, I don't want to fool with that. I don't want to be getting calls in the middle of the night about, the water heater. Well, you don't have to, and you don't have to self-manage it. And there's a lot of misinformation. I wanted to revisit this again. There is so much misinformation among the tax community out there of tax preparers that really tell people the wrong things, where I've been on calls where our tax team has pointed out, on a group call, and asked point blank to these CPAs or tax preparers, can you show me where it says that in the code? And they don't know. And they sort of get called out, and they're put on the spot. But this is the push and pull. You've got people out there. It's a weird thing in tax world. You're really only as good. There's a saying: you're only as good as what you can defend. So we have a team that is expert at counseling and coaching people through the process so that they're airtight. If there ever is an audit, there's audit protection. Our team, welcomes an audit because, our litigators, our attorneys, show the IRS agent, who is, what the guideline is, or where we have our documentation, where we justify the deductions. So we work at a very, very high level, and I wouldn't have, I was a client first. I didn't know. I bought a property, met a friend at an event, and that friend happened to be the principal director of a CPA firm that had just moved to Nashville from Denver. Became great friends. I became a client, saved me $100,000 out of my pocket in taxes. I get a $300,000 tax deduction, and the rest is history. Now we teach other people how to do the same. And there's no shortage of people out there that are teaching about this, on Instagram. And it's really the people that really are in the know. But there's definitely a lot of people out there that are still telling people wrong things. They're telling people this doesn't apply to you. And the idea is they don't feel like they can defend it. And so they're just taking the easy route. So the key is building trust. A team, our tax team builds trust with clients, but you still have people that are beholden to their dusty, CPA that's been telling the same thing, and they've had their CPA for 25 years. And I'm just telling you, some people are just wrong. There's differences of opinion, and some people it's just an opinion, and some people, like in this case, our side, we're just right. So you want to make sure that you're dealing with professionals that know what they're talking about when you're dealing with these types of things. It's your life, it's your livelihood. You know, it's important stuff.
All right. Well, listen, Mark, I appreciate you being here today. I don't know if look like there's any more questions at this point, but everyone go follow
Okay,
Mark
guys.
on social media. He's fantastic on there as well. Very educational. Yeah. But I really appreciate your time today, Mark.
Thanks, guys.
Okay.
Talk to you soon. See ya.
All right. See you, everyone.
Bye bye.